On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risk and none are guaranteed. So before you make any decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners financial advice provider disclosure statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Morning team, hope everyone is well. Let's talk about last week, then let's turn our attention to what's coming up in the days ahead. Last week was shaping up as a fairly solid one for global share markets until Friday when Israel launched a wave of airstrikes on Iran, and that saw risk assets weaken, it saw oil prices spike, and it made an already tense geopolitical backdrop become slightly more complicated. The S&P 500 index in the US slipped 0.4% for the week. European shares were down 1.8%. Japan fell 0.5%. Most of that weakness came on Friday. Equities in the UK, Australia and emerging markets managed to eke out small gains, while the NZX 50 here in New Zealand was marginally lower. But I think you will see the New Zealand and Australian markets start on the back foot on Monday morning as they play a little bit of catch up in terms of those events that we've seen since we closed on Friday afternoon, New Zealand time. Oil prices ended the week 13% higher. There was a big rise on Friday, and gold was one of the few things to go up as investors looked for safe haven assets. Gold prices rose almost 4% last week. Interestingly, US Treasury yields actually rose slightly on Friday, so US Treasuries didn't seem to be the typical safe haven asset that we expect them to be in that sort of environment, but they still did finish the week lower than where they started. So the 2-year yield was down slightly at 3.95%, and the US 10-year Treasury yield fell from 4.5% to 4.4%. Here in New Zealand, the 5-year swap rate was little changed. It ended last week at 3.6%. In terms of the key releases, the big one last week, and the only one I'll really dwell on, was the US Consumer Price Index for May, the CPI. It came in below expectations, suggesting that many companies out there are holding back from passing on those higher tariff-related costs to consumers. We're not completely out of the woods yet. There still is an expectation that we might see tariff-related costs increase over the balance of the year, but for now we're not quite seeing it. The headline CPI increased just 0.1% for the month. The market was expecting 0.2%, and the core CPI rose also 0.1% for the month. The market expected 0.3%, so lower than expected at both the headline and the core level. In terms of the annual pace of inflation, the headline CPI rose 2.4%, below forecasts. Markets expected 2.5%. Core inflation rose 2.8%, also below expectations and the same as the previous couple of months. Now, important to note that despite those headline increases coming in below forecasts at the core and the headline level, a few signs of tariff-related price pressures were still evident when you look under the hood. We saw this in things like household furnishing and supplies. We saw it in recreation commodities, motor vehicle parts and equipment prices also pushed up a little bit. That will likely continue in the coming months as those tariffs have more of an impact. So good news, but we still need to watch this space in terms of US inflation. Turning to the week ahead, now events in the Middle East will be a real focal point. I think investors will be watching for any signs of further escalation between Israel and Iran, and importantly, to see whether any other countries like the United States end up getting drawn into the mix. That is not what we want to see. You want to see things like this contained and over as quickly as possible. You don't want to see them escalate, and you certainly don't want to see other bigger powerful countries enter the fray somehow. So that is something investors will be watching really closely. Also, we have the G7 Leaders Summit taking place this week. It's being held in Canada. It takes place early in the week. We'll be watching for any talk about trade deals, anything like that. And also that comes ahead of the NATO Summit next week. I think that's on the 24th and 25th of June. So lots going on the geopolitical front. Outside of that, and keeping an eye on that Middle East situation, it will be a very big week for central banks. We've got monetary policy decisions in the US, the UK, and Japan. None of those central banks are expected to adjust policy rates, no changes to interest rates, but the tone and the commentary will be very important. The big one will obviously be the Federal Reserve in the US. Now, its decision will be released at 6 a.m. on Thursday morning here in New Zealand. So you can tune in to CNBC or whatever your preferred business channel is. Watch that come out at 6 o'clock in the morning on Thursday. At 6:30, you'll get the press conference with Fed Chair Jerome Powell, and that's where we'll get a lot more information. And you often see markets react more to the press conference because that's when we all get a better feel for where the Fed is actually at. So 6 a.m. Thursday morning. Right now, the upper bound of the Fed funds rate, they do a range, not just a number like we do here in New Zealand for the OCR. So the upper bound of their range is 4.5%. That's down from a peak of 5.5% last year. So it's come down, but it hasn't come down nearly as much as we've seen in New Zealand or in places like Europe. So the Fed has been a little bit more cautious about easing monetary conditions. This week, not expected to see any change, so interest rates expected to remain the same, but we will be watching the comments. We want to know what the Fed is thinking about some of those risks out there, both risks to growth and potential inflationary risks. Right now, markets expect 2 more rate cuts from the Fed this year, so 2 more 0.25% rate cuts. That would take the Fed funds rate, the upper bound, at least down to 4% from where it is currently. Not expecting to see the first of those until maybe September-ish, so they're expected to be on hold for a little bit longer. The other important thing about this particular Fed meeting is that we will get a fresh summary of economic projections, an SEP, this week. That would be the first that we've seen since March, and it will allow us to delve a little bit deeper into how the Fed's thinking might have changed over the last couple of months. Right, also central bank meetings in Japan and the UK, so those will take place this week. Neither of those central banks likely to adjust policy settings, but again, it will be the comments and the tone. The BOJ decision likely to be out on Tuesday afternoon, so that will come out a little bit earlier in the week. It is still in the process of normalising monetary policy after a long period of negative interest rates. So the next move from the BOJ will be up. It will hike rates when it does next make an adjustment. That probably won't come until late in the year, though. The Bank of England, it releases its decision on Thursday as well, like the Fed, but that evening. So you'll get the Bank of Japan first, Tuesday afternoon, then the Fed Thursday morning, then the Bank of England will be the third one, Thursday evening. Now, the BOE has reduced its policy rate 4 times this cycle, so it's down at 4.25. So we're at the lowest in 2 years. I don't think they'll make a move this week. There is more to come from the BOE, 2 more cuts, I suspect, over the next little while, but I don't think you'll see the next one until August or September. So they're just pausing as well. And interestingly, at its last meeting, the committee was split. So you had the committee members voted 5-4 in favour of the last cut, which was a 0.25% cut, but 2 of those people actually wanted a bigger cut of 0.5%, and another 2 said we should leave things on hold. So there's a bit of a disparity in the thinking from those 9 voting members at the Bank of England. So that one will be interesting to watch. Right, a few other things going on. In China, we will get monthly activity indicators on Monday afternoon. Across the Tasman and Australia, we will be watching the labour force report. That is out on Thursday afternoon. The unemployment rate currently 4.1% and expected to remain unchanged. Here in New Zealand, there's quite a bit going on. We should get a fresh housing market report from the Real Estate Institute early in the week. I'm expecting that on Monday morning. If it's not Monday, it should be on Tuesday. This will cover the month of May. housing market been a little bit mixed of late. You haven't really seen any movement in prices, at least not in a big way. The market's stable, but it's not really doing much. And activity still is a little bit subdued in places. Affordability is still a challenge. There's still a lot of caution out there about job security from buyers. So the unemployment rate has been moving higher, and it's expected to go maybe a little bit higher still. So that never does you too many favours in terms of the housing market, but it will be good to get an update. We'll also get the results of another dairy auction out early on Wednesday morning, and then the key release will be the March quarter GDP report, which is out on Thursday. So this will be out at 10:45 Thursday morning. It's a big day Thursday, isn't it? Start with the Fed, then we'll have the GDP report. We've got the Bank of England that evening. The RBNZ is expecting a quarterly increase of 0.4% for the March quarter. Now, that would be down slightly from what we saw in the final 3 months of last year. It was a 0.6% rise we saw in the last 3 months of last year, but the economists out there are a little bit more upbeat. So they are forecasting 0.7%, so more than the RBNZ. Now, while the economy has lifted itself out of recession and we're now talking about growth, it's very sluggish growth. It still isn't anything to get too excited about. So we're hopeful that that pace of improvement will pick up later this year and certainly into 2026. But this will be important. We'll all be watching this on Thursday morning. I guess from an RBNZ perspective and thinking about the official cash rate, the next RBNZ meeting is in July. My feeling is that they won't do anything then. I think there is another cut, maybe two, still to come, but I don't think we'll get one in July. I think the Reserve Bank will pause and they'll maybe wait till August or even later in the year before they move again, because they've reduced the OCR by quite a bit and they can now afford to just go a little bit slower. And take their time a bit more. And a stronger than expected GDP report, if it does come in at 0.7, 0.8% even, higher than what the Reserve Bank is expecting, 0.4, then that would probably support that view. I think that would make markets more comfortable expecting the Reserve Bank to pause. Doesn't mean there won't be any more OCR cuts. It just means they're not going to do one at every meeting like they have done so far. So that's where we're at. Lots to watch, and I think it will be those geopolitical tensions in the Middle East that take centre stage, at least in terms of markets. If you're worried about that, if you're thinking about what it means for your portfolio, get in touch with your advisor. There are things that we can do to not completely de-risk things. You can't, there's no silver bullet, but you can at least position your portfolio in a way that will leave you a little bit more insulated from some of those events. Maybe you have some more safe assets, some more bonds, some good quality fixed income, not necessarily in the US. That's maybe a bond market you want to avoid a little bit more than you usually would have, but I think New Zealand bonds still look attractive, and global bonds in other places will provide a little bit of support. Maybe a little bit of gold, not too much, but maybe a little bit as a hedge. Maybe some of those other assets that do tend to perform well when you see these geopolitical events, whether it's energy stocks, because you often see a rise in oil prices. Commodities tend to give you a bit of protection about inflationary risks. If you're comfortable, sometimes defence stocks and so forth can perform well, and just some of those sectors that tend to be a bit more resilient when you've got an economic slowdown that is potentially looming, whether it's healthcare, whether it's consumer staples, infrastructure, utilities, good quality real estate. There are things you can do. Maybe hold a little bit more cash, because we do hope that the situation will blow over and not develop into anything worse. But if you've got a bit of cash, you can actually take advantage of some of those periods of weakness. If markets do get very nervous and you see a bit of a sell-off, that can create some good entry points for us to buy some assets that we've been looking at cheaper prices. So lots of things you can do. But talk to your advisor, and otherwise, enjoy your week. We'll talk again soon.
For more insights, visit craigsip.com.